In this video, traders, let's have a look at chart patterns versus indicators. Stay tuned. Hey traders, warm welcome to you. Alright, so it's a good suggestion from a viewer, maybe a subscriber, I don't know, comment was on a previous video, chart patterns, or how useful are chart patterns versus indicators. Now, I've never really thought about separating them so extremely like this. To me, they kind of go hand in hand. A chart pattern and an indicator is a similar type of thing, but really when you think about it, it's actually not. So this is a good kind of thing for us to think about and delve into. So chart patterns versus indicators. So a chart pattern, let's use an example so we know where we are with this, would be something like, okay, a head and shoulders, maybe some kind of candlestick pattern like a shooting star, maybe something like a trend line channel or something like that, something that's actually on the candles itself, whether we're talking about a group of candles and it's a candlestick pattern, or a broader pattern on the chart like the head and shoulders, like the lower high, etc, etc. Whereas an indicator, obviously we've got thousands of indicators, moving averages, stochastics, Bollinger Bands, etc, is derived from price, sometimes volume, sometimes time, and we use these to guide us into making trading decisions. So let's have a look at a comparison between the two. So this is my thoughts. Again, don't say I'm right or wrong on this. This is a kind of unusual topic to look at. It would be interesting to hear what you guys got to say about this in the comment section below, as always. All right, so pure price versus price derived. So this side, of course, we've got our chart patterns. Let's make that clearer here. And this side, we've got our indicators. So pure price is obviously one of the benefits of using a chart pattern, right? It's just literally price. There's nothing else to worry about. Whereas an indicator is derived from price anyway. So you're always looking at a second derivative. A moving average is the average of price over a number of days. Stochastics, the same kind of thing, divided by the number of days. You've got Bollinger Bands with a standard deviation. So everything that we're looking at, the common indicators, are all derived from price anyway. So the argument could be, well, you can often see what the indicator will be just by looking at price. You know, if price suddenly starts to rip off high, you pretty much know the moving average is going to be trying to catch up. But if it's a recent rip, it will be kind of catching up slowly, depending on the distance or the size of the moving average you've got, or the number of days of the moving average. Same with the stochastic. If it's kind of been in a range now, it's breaking out to highs, you kind of know it's going to be overbought, because the stochastic just looks at the period you're looking at and then decides what the price position is in that. So you can kind of get a good idea. So do you necessarily need indicators to get this feel? Maybe, maybe not. So that's one thing to consider. The other thing is they're there, then gone. Value changing. What do I mean by that? So there, then gone means that, hey, most of the time a chart pattern will be there and then it disappears. And let's say, okay, you're going to use an example of a higher low, okay, or a 1, 2, 3 pattern or something like that. You have the low. Okay, tell you what we use double bottom, because it's very easy to kind of visualize on our mind as well. Markets come down, and then that's it. Once we've had the double bottom, it's gone. Okay, we are now, from this point onwards, we're now in the territory of we did just have a double bottom. But then where do we consider that still valid? Up here, is it still valid double bottom there? Well, you might be considered to be chasing it a little bit there. What about right down here? Is it valid? Well, might not even have been done yet. So the point is here is that you have it and then it's gone. You have to decide how valid and relevant that is coming up into future trades. Whereas an indicator has a constantly changing value. So the moving average, let's say stochastic is a great example. Let's say it's gone oversold, okay, but then it goes back into neutral territory. It's no longer oversold. There's still a reading which you can judge from it. So you're like, okay, well, it's this or the other. Whereas you've got a chart pattern. It's like a binary event. It's done it, and that's it. So how do you kind of look at it from now? Do you look at it with some more weighting, less weighting? Whereas an indicator, you can go, oh, we're in the middle of the range now. You can see the value is changing. Or the moving average, you know, is now at this distance away from the price, or this distance away from the slow moving average, or whatever it may be. So the indicator is always giving you a value wherever it is. A chart pattern, either it's formed and it's gone 10 days ago, 2 days ago, or it's forming. And there's no kind of in between. It's difficult to judge sometimes how much influence it has on it, whether it's kind of worked its way out. That, for example, you could be thinking, oh, it's a double bottom, but in fact your stochastic's now gone overbought, and maybe you're better off waiting for a kind of retracement or consolidation before buying, that kind of thing. So something to consider there. These is very similar, guys. It can be misleading on lower time frames. I think this is the same for both chart patterns and indicators, if I'm honest. You know, lower time frames, it's not that useful. 1 minute, 3 minute, 5 minute, it can be in the right conditions, don't get me wrong, but I think that majority of the 5 minute bars, 5 minute candles are relevant. You know, no one cares what happens in 5 minutes. Whereas a daily or weekly or monthly becomes more interesting. Far more money is involved in that candle than in a 1 minute candle or a 5 minute candle. So very similar there, guys. They can be misleading on lower time frames. Indicators can have stochastics swinging around on a 1 minute. Stupidly can be sitting in a range for kind of 14 minutes and then just pop out of the range. All of a sudden it's overbought and everyone's crying. It doesn't make any sense. The same a little bit with our time frames, double bottom, double top on a small tight range, intraday and a 1 minute chart, completely irrelevant. The other advantage with chart pattern is I think you get a better feel for the market. Because you're watching pure price, you're seeing how it moves, you're seeing how price responds, you get a better feel. Whereas I think you're one step removed. I guess it's similar to the price derived, but you're one step removed with an indicator. If you're always constantly looking at an indicator, you're constantly just looking at a purely one digit. In other words, hey, this is the indicator, this is the value of the indicator, whereas price, you know, it's very much it's very different the way that these chart patterns form, isn't it? If you think about, you know, double bottom, we can have like a double bottom that is big there and kind of breaks through lows. You can have a real tight one here. There's so many different variations. Whereas an oversold stochastic is just a number. Hey, it's 20, or it's 15. It's a number. Yes, there's some intricacies potentially of how it gets there, but it's so much narrower than it is perhaps price, because price has got much more to look at, and the chart pattern can be much more interesting. The position of that relative to the day, difficult to kind of sometimes judge that with indicators. This is not a bashing indicator video by any stretch of imagination, but just understanding some of the intricacies of trading either chart pattern or the indicator. A final one is one against the chart pattern here is that it can be subjective, whereas an indicator is binary. You know, if your moving average is crossing over, then it's crossing over. It either is or it isn't. If you're oversold, you're oversold. You're either oversold or you're not. And you've defined it and it's yes or no. Now, I know that some chart patterns are like that. Let's say you've got a head and shoulders, as soon as it crosses that, it's formed, but there's still some subjectivity there, right? And a higher low, etc., fine. But there's still, at some point, there's some subjectivity. At some point, the stochastic or whatever indicator you're using, at one level, it goes into overbought or oversold. It's very, very clear. Whereas here, where do we call it a double bottom? You know, down here, well, at the moment, if it's down here, you're through the low. At the moment, it's not. As it's come back up, is it still a double bottom yet? So you've got some subjectivity there, which can make it challenging to decide whether it's valid or not, whether it's formed or not. And then the other argument, of course, is that after it's formed and you say, oh yeah, that was a double bottom, maybe it's too late to even respond to it. So there's something to consider there for that as well, guys. So chart patterns versus indicators, not really a face-off that you'd expect. I think there's place for both of them. I think it makes sense to kind of be mindful that you're not flooding your chart with indicators. Same with chart patterns, not look at every single chart pattern out there. Just pick a couple of things that you think are useful for your strategy, recognize the downfalls of them, recognize the power of them, and then kind of try and use a hybrid model in your trading. That's what I do, and it seems to work okay. Take care, guys. Bye-bye.